Welcome. If you are self-employed and running your own small business right now, understanding how taxes work is one of the most important skills you can build. This video walks through the general process that many founders follow to stay organized with income reporting, expense tracking, and payments to the IRS. Before we begin, please remember this is general education and entertainment only, and not legal, tax, or financial advice. Laws, amounts, and deadlines change every year and vary by state, so you should consult a licensed CPA or business attorney about your own situation. The tools shown later are linked below, and some are affiliate links that support the channel. Self-employed taxes differ from traditional W-2 employment because you are responsible for both the employee and employer portions of certain taxes. In general, you report business income and expenses on your personal return using a Schedule C, and you may need to make estimated tax payments throughout the year. We will cover the main concepts step by step, so you can build a repeatable system that fits your business. Many first-time founders start by separating personal and business finances, which makes record-keeping far easier when tax time arrives. Others use simple software to categorize every transaction automatically. The goal is to create clear records that show what came in and what went out, so you can calculate your taxable income accurately. We will also discuss common record-keeping habits, payment timing, and how business structure choices can affect your filing approach. By the end, you will have a clear checklist you can apply immediately to your own records. Step 1 is understanding the basic concept of self-employment tax. In general, this refers to the Social Security and Medicare taxes that self-employed individuals pay on their net earnings. Unlike employees who see these amounts withheld from each paycheck, you calculate and pay them yourself when you file. The IRS treats self-employment income as business profit after allowable expenses, so your first task is to determine what portion of your revenue counts as profit. For many founders, this means separating business revenue from any personal funds that may have entered the account. You then subtract ordinary and necessary business expenses to arrive at net profit. That net profit becomes the base for calculating self-employment tax. Keep in mind that thresholds and amounts change every year, so check the current IRS figures or ask a CPA. A common approach is to set aside a percentage of every payment you receive so you are prepared when payments are due. This habit prevents surprises later. Another useful step is to review IRS Publication 334 or similar guides that explain self-employment responsibilities in plain language. Many new solopreneurs overlook that self-employment tax covers both the employee and employer shares, which is why planning ahead matters. Building this foundation early helps you see why accurate record-keeping in the next steps is so valuable. Step 2 is opening a dedicated business bank account and keeping personal spending completely separate. This simple action makes every later step easier because all deposits and withdrawals related to your work stay in one place. In general, the IRS expects you to maintain clear records that show business activity only. When personal and business transactions mix, it becomes harder to prove which expenses are deductible and which are not. Many founders choose an account that offers easy categorization tools so they can tag income and expenses as they happen. Others add a business credit card for larger purchases. Either way, the goal is consistent separation that stands up to review. You should also consider whether your state requires any specific filings when you open the account. Rules vary by state, so verify with your local banking requirements or ask a professional. Once the account is active, route all client payments and vendor bills through it exclusively. This creates an automatic paper trail that bookkeeping software can read without extra effort. The habit also reinforces the idea that your business is a distinct entity, even if you are a sole proprietor. Over time, this separation reduces stress during tax preparation because you already know where every number came from. Step 3 is building a daily habit of recording every dollar that comes in and every dollar that goes out. Accurate tracking is the backbone of correct tax reporting because your net profit determines what you owe. Tools like QuickBooks or FreshBooks can connect directly to your business bank account and automatically categorize transactions, which saves hours of manual work later. In general, you want to record the date, amount, payer or payee, and a short description for each item. Keep digital copies of receipts and invoices so you can match them to entries. Many founders review their accounts weekly rather than waiting until the end of the quarter. This catches errors while the details are still fresh. Remember that only ordinary and necessary expenses related to your business are typically considered. Personal expenses do not qualify, which is another reason separation matters. Thresholds and deduction rules change annually, so review current IRS guidance or speak with a tax professional about your specific case. Consistent tracking also helps you spot cash flow patterns and plan for slower months. Over a full year, these records become the source documents for your Schedule C and any estimated payment calculations. Step 4 is setting up a system for estimated tax payments. Because no employer withholds taxes from your income, you are generally responsible for sending payments to the IRS throughout the year. A common approach is to calculate your expected annual tax based on current profit and divide it into 4 quarterly installments. Amounts and due dates change every year, so always check the latest IRS instructions or consult a CPA. Many founders use a simple spreadsheet or their accounting software to project profit and set aside funds after each client payment arrives. This prevents large balances due at filing time. You can make payments electronically through the IRS website or authorized providers. Keep confirmation receipts for your records. If your income fluctuates, you can adjust the amounts you send each quarter. The key is to treat these payments as a regular business expense rather than an afterthought. Some states also require estimated payments, and rules vary by state, so review your state revenue department guidelines. Building this habit early keeps cash flow predictable and reduces the chance of underpayment penalties. Step 5 is reviewing which deductions and credits may apply to your situation in general terms. Common categories include home office costs, equipment, software subscriptions, marketing, and professional services, provided they meet IRS ordinary and necessary tests. Keep in mind that rules and limits change every year and vary by state, so verify current figures with official sources or a tax professional. A useful practice is to maintain a running list of potential deductions alongside your receipts throughout the year. This makes it easier to maximize legitimate write-offs without guessing at filing time. Some founders also track mileage for business travel using apps that integrate with their bookkeeping software. Others document the business percentage of shared expenses, like internet or phone service. Liability protection and audit outcomes depend on following formalities and maintaining accurate records, and protection is never absolute. Always ask a CPA or attorney about your specific facts. Credits such as the qualified business income deduction may also enter the picture, but eligibility depends on your overall tax picture. The goal is to understand the categories so you can gather supporting documents well before filing season. Step 6 is preparing and filing your annual tax return once the year ends. In general, sole proprietors report business activity on Schedule C attached to Form 1040. You will also complete Schedule SE to calculate self-employment tax. Many founders use tax software that imports data directly from QuickBooks or FreshBooks to reduce errors. Before you file, reconcile every bank and credit card account against your records so the numbers match. Double-check that all estimated payments appear correctly on your account transcript. If you formed an LLC, confirm whether you need to make any entity-level filings with your state. Requirements vary widely. Keep copies of the final return and all supporting schedules for at least several years. Filing electronically with direct deposit for any refund speeds processing. If you owe additional tax, you can often set up a payment plan through the IRS website. The entire process becomes straightforward when you have followed the earlier steps consistently. Remember that this is still general education only. Your personal filing may involve additional forms or elections, so consult a licensed professional about your own situation. In summary, the process starts with separating finances, continues with daily tracking, includes regular estimated payments, and ends with accurate annual filing. Each step builds on the last to create reliable records that support your tax obligations. This is general education and entertainment only and not legal, tax, or financial advice. Consult a licensed CPA or business attorney about your own situation, because laws, amounts, and deadlines change and vary by state. Subscribe to Founder Filing for more plain English walkthroughs that help new founders stay organized. _line.